All right, sorry about that, guys. So we went down there. YouTube ended up crashing out on my side. So again, we are meeting today. We're looking at the Fed meeting. The Fed at 1:30 Central Time met, and we've seen stocks and all sorts of responses begin to happen. So I wanted to share with you some of the news and give you an idea about what that means for the upcoming year and the expectations. Um, so I am going to share my screen real quick, and I'm going to show you a couple of things so you can see what we've been looking at this year. First of all, I want to show you this. This is the 10-year Treasury yield. If we go back around October of this year, really as you entered into November, we were at the peak for the Treasury yield. Now, if you know real estate interest rates, mortgage rates, they essentially follow the 10-year Treasury yield, basically. Okay, so as they follow that Treasury yield, interest rates go up as the Treasury yield goes up. And that sometimes is not dependent on the Fed's raising rates. Sometimes things happen that cause the Treasury yield to go up, and interest rates are going to follow that. Well, a couple of reports have come out during this period of time between October and today, and those reports, jobs reports, inflation reports, have shown that inflation is slowing and the job market is starting to hit a point where the Fed is getting more prepared to reduce rates. So the Feds didn't actually change anything. All of this change here from up around 5% down to 4 was not from the Feds cutting rates. That was just from the news that the Feds may cut the rates, if you follow that. So the Treasury yield is responding to all of these news cycles and to the things that are happening. And that's because there's so much uncertainty in the market. So I'm also going to share with you one more screen share. I just want to show you and you may have saw it in that video or in that screen share that I did. All right, so if we go here, we're looking at the Dow jumps 300 points, heads for a record close after Fed signals several rate cuts next year, and that's really what we want to talk about today. Is they're not saying that they're going to be three rate cuts next year. They're signaling that that is a significant possibility. What does that mean? Three rate cuts for next year. I've been saying this for a little while. If you watch my last market update in November, what I said was they don't have to cut any rates. All they have to do is say that they're done raising rates, and we're going to see markets respond. We're going to see interest rates start going down. We're going to see the treasury yield start to go down, and we're going to see stocks respond. So just the statement that they're looking at potential rate cuts next year is a signal that we're probably at the end of rate hikes. That is enough to get us into 6% mortgage interest rates territory. Now, I have a subscription to a site that will track what average mortgage interest rates are. And today we're looking at 6.978, 6.98, right at 7%. We're actually slightly under 7. That's exceptional that we're under 7% when we were over 8 4 weeks ago. So this is the trend that the market is beginning to follow, and that is a significant piece of information. Let me share this screen with you so you can see what I'm looking at. So this is the current mortgage rates today, 6.978. That, like I said, we were at 8.1, 8.2 4 weeks ago, and this is kind of what people are averaging across the nation. So this is aggregated from lots of different sources. Okay, so today we wanted to meet. Let me start sharing this. So today we wanted to kind of hop on YouTube to kind of go over some of the things that they were talking about. So inflation came back at about 4.4%, which was higher than what their target 2% is. If you listen to them, they will mention that 2% target rate over and over and over again. It's very important for them to hit that. We were at like 4.4, which on the surface doesn't sound good, but there's a lagging indicator that is the most significant of all the metrics that they track, and that is housing. And what they're specifically looking at is rent. I own a property management company, and rent right now is low. So there's been a deflationary pressure on rental and leasing rates around the nation, and especially here in North Texas. We've definitely seen rates drop on what people can rent homes for here in our area. With that said, the Fed's track data that is about 12 months behind on that. So if rents have come down, it's not being looked at in their data. So if you just take rent data out of the stuff completely, just take it out completely, just look at everything else, the inflation numbers are about 1.4%, which is below the 2% target. So with that in mind, the inflation data is actually slightly better than what the initial assessment actually suggests, and they know that they actually mention in their press briefing today that that the some of the lagging indicators are being accounted for, and rent being one of the primary ones. Let me pull up. Let me pull up this meeting,
Other officials, even those
and
who,
so
who
we
work at
can.
the Fed. But I'll try to answer your question more broadly. Um, so the way we're looking at it is
Watching some of them. So the I mentioned that they're expecting three rate reductions, rate cuts next year. That's kind of the idea based on their trajectories. So if interest rates were to just stabilize and there was a normal spread between the treasury yield and mortgage interest rates, we should end the year at about 6.7, 6.8%. That's kind of my expectation. I think that we will end the year under 7% based on the meeting that the Fed just gave. We should be dropping under 7% unless something changes. Based on what we're looking at, that is a realistic expectation at this time. Next year, probably not January. They're probably going to hold tight on January. They may hold tight on February. I think, especially as we get closer to the election, what a coincidence. Once we get closer to the election, I believe that there will be some movement on the rates. I believe they will do a cut probably in March and in April and in May. I bet they'll do three consecutive cuts going into the summer or the spring market. And we should see interest rates probably low six, maybe high fives by summertime next year is kind of what I'm thinking based on the what I've seen so far. That's just me projecting. I could be dead wrong. There could be I could definitely have some missteps, but in general, if we are between 6 and 6.5, um, between January and December of 2024, we should see a relatively strong market. There should be a lot of movement with people that are going to be coming off out of the woodwork, out of the bushes that have been kind of hiding out and saying they're just going to wait for these 8% interest rates to go. Well, it looks like they're gone. It looks like we're sitting in the low sevens, and even today we're in the very very high sixes. 6.98 is basically seven, but we just crossed that 7% threshold. And it looks like the market is going to improve next year, and there's going to be a flood of new inventory hit the market. I expect that that is going to have a lot of different effects in different markets. And it's hard to anticipate exactly what that means. If you're a homeowner and you're looking at the market, there's a possibility that we might see one of the bigger surges of inventory in the last 10, 15, 20 years this spring. Now, a surge of inventory means lower prices. It also means better deals when you buy, but it means lower prices when you sell. And so if someone's trying to like maximize profit on a investment property, you probably want to get slightly ahead of that surge. If interest rates, get into the high fives, I mean, we're going to see properties that we're going to see a lot of homes hit the market that people can finally move and make the move that they've been wanting to make for the last 2 years, but have been unable to. So you have all this what they call pent up demand that are kind of on the sidelines that want to move, want to upgrade, want to go buy a home, want to go buy some land and build or whatever they want to do. And the interest rates have just been restrictive, and now they can't. So they're just kind of waiting for that to open up. And 5% interest rates would probably open that up. And if it did, there would be a lot of homes that would hit the market, and a lot of people would have to sell, or a lot of people would have to compete with one another in order to sell, and that's what drives the prices down. And honestly, like I said before, if you're moving from one property to another, the main thing is that if you're buying a home and you're getting a better deal on it, making a little bit less on yours is not necessarily that big of a deal. It's overall a much healthier economy, at a 5.5% interest rate, and the prices kind of stabilizing, and everybody is able to get lower mortgage payments every month, even if there is a little bit less equity. So, yeah, I think when you start trying to talk about timing, how do you time it? What if you got a property and you're thinking about selling in the spring next year, but you have to risk putting your home on the market when 152 people with the same type home put it up at the same time. You have this just weighing the options, and honestly, it's hard to hit that nail right on the head. It's hard to get that precisely correct. Timing is going to be relatively difficult. With that, I think that the market is going to be strong coming into next year. Uh, I say strong; it's going to be strengthening. That's a safer statement. It's going to be strengthening. It's strengthening now. We're seeing increases in demand. We're seeing people getting back into the market now, and that was at 7.1, 7.2% interest rates that we actually saw some movement. When they hit 8%, um, I got into this business. Interest rates for 5%. It was about 13 years ago, and we were at about 5.5% interest rates. And so that was the highest that I've ever seen. And I can tell you that I've seen some ups and downs in the real estate market over the last, 13 years. Uh, when they hit 8% back, September, that was the worst market I've ever seen in real estate. Everything seemed to have just completely stopped for me. Showings basically went to a halt. Buyers were basically prohibited. People that wanted to sell, now they can't. The whole market just kind of went stale all of a sudden. I had a few clients that were, inherited properties and had to get rid of them, and just it is what it is. And so you never know what's going to happen. A war may break out tomorrow with Ukraine, Russia, and Israel. All that going on the sidelines. You never know what's going to happen, and it's hard to predict if you should wait to sell. Even if you did inherit a property, it's hard to predict what you should do. Um, so thoughts going into next year. You're thinking about selling your home. Yeah, so the Dow just surpassed 37,000 for the first time. So it is setting records. It's up over 400 points based on this meeting with the Fed, the Federal Reserve today. So the markets are responding to this meeting with the Fed. And honestly, we've been waiting on it for weeks. I've been tracking the jobs reports and the CPI reports and following different things. And I have a lot of clients, honestly, that are talking to me. It's like, look, we want to sell, but the interest rates need to come down, and we know how slow it's been at 8%. And so they're asking me, what should we do? Should we go ahead and do it now, or should we wait till the spring? And so I feel the pain and the pressure of trying to figure that out. I think if I was to make a recommendation, is with interest rates coming down, most of the time it's better to put your home on the market middle of March, because there's gonna be so many homes hitting the market at that time. It might make sense to try to maybe get in a little early. If you can be in on, the first wave, maybe first week of February, you might be a month and a half ahead of, the normal spring surge. And so you might get an advantage there. If I were doing it, if I were putting my house on the market, that's probably what I would do. I'd probably, the mid-March when, golf and is kicking off and the weather's starting to get warm, I'd probably 4 to 6 weeks ahead of that. Try to get in on the market, and that way you can, if there isn't a wave of buyers that are coming in that spring market, you can be in that first group. Your house will sell, and then people will see the real estate market moving, and then you'll see just a flood of homes hit the market. Um, that's what I would think, at least, based on what we're seeing. So let me go check. I'll get in. Let me go see what the mortgage rates have done since a moment ago. So they're still 6.978. Let's refresh the 10-year Treasury yield. Okay, yeah. So 4.028 on the 10-year Treasury yield. Again, we peaked out 4 to 5 weeks ago at 4.9. So we're at 4.02 or 4.03 now, on the Treasury yield. So it's down significantly, and it is responding to the Fed meeting that happened today. Again, as a recap, the Fed met. They did not say we're not going to do any more rate hikes. They didn't say that. So we haven't had that strong of a statement. They said they're monitoring everything, and it would take something shifting in order for them to do a rate hike. So what the sentiment is, they're not planning to do a rate hike, but there is a possibility that it could happen if inflation were to turn around and not go in the direction that it has been going. Um, then they said they're anticipating 3 rate cuts next year, and they showed a graph and kind of showed of kind of how that looked. There's going to be rate cuts for 2025 and even 2026, and kind of what they were thinking it would be, 2 to 3 years down the line. They also, it acknowledged that the further out the projection, the less certain that it is. So the idea that they're going to do 3 rate cuts next year is highly probable. And there's several other reasons for that I don't want to get into, with debt loads and interest rates and the yields and the economy and the nation having to pay its own debts. But with where we're at right now, it looks like the Feds are going to cut rates. It looks like the economy is responding well to that. It looks like there's not been a major job loss recession that's happened. It looks like they've been able to kind of get a handle on inflation without causing a tremendous amount of job losses all at once, which is great news. Man, that's one of the things that has been the more difficult aspect of this for me. Is I know that as soon as people start losing their jobs, interest rates are going to come down. And like, I'm feeling the pain in the real estate market, but people start losing their jobs. It's scary because there's less people that can afford homes, and it becomes very volatile. Things can go sideways for everybody, including me. Um, and it seemed like that's what the Fed were pushing for. So I am very thrilled that we don't have a job loss recession, and we do seem to be moving in a lower mortgage interest rate direction in the foreseeable future. I appreciate if you tuned in live today. Thanks a lot. I'm putting this video out. I'm not doing any videos for the month of December. So when I say I'm not doing any videos, I'm not doing any normal videos that I'm editing and doing all of that. But I figured I would jump on at least maybe this time, maybe 1 or 2 other times before the new year. Probably just one more live update. I'm just doing these live just to give some updates on some of this. But come January, we will have I'll have my lender come back on, and we'll do a deep dive into the mortgage market. And as always, I'm working on a couple of different projects as far as some waterfront communities around Granbury. And yeah, so I hope this was helpful. Hope it was insightful. Hope it made your plans easier, not harder. And if we don't hear from you, I hope you guys have a Merry Christmas, Happy New Year, and stay tuned for next year. We will have some videos rolling back out. So appreciate you, and everyone have a good one. Thanks.